Good afternoon and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, February the 16th, and wanted to take just a brief moment to discuss what markets did last week as we did pull back a little bit from the rip-roaring rally that we've seen so far to start the year. The S&P 500 was down 1.11% on the week. The mid-cap index was down 2.52%, and the small cap index is measured by the S&P 600 was down 3.90%. So small and mid were worse than large, but are still doing much better year to date than the large index has done so far. So as we were heading into this week, all eyes were on this week's CPI report, which came in a little bit higher than the analyst expectations on a month over month basis, but still trending in a downward trend. So what was very interesting is how the market reacted to this report. Had this report come out, say, maybe last June, July, August, even back into October, November, you would have seen the markets really come down severely, maybe down 1, 2, maybe even 3%. We've seen 1,000-point days on the Dow off of bad inflation reports within the last year. But the markets finished the day that day relatively flat, just slightly down on the S&P and the mid-cap index, just slightly down on the day. And what investors are looking at is they're looking at more of a trend. They're understanding that 1 month doesn't make a trend line. It doesn't make or break a trend. The overall trajectory of inflation is coming down. The Fed is lowering the rate at which they're raising rates. And hopefully investors are hoping for 2, maybe now 3 more 25 basis point rate increases for the rest of the year. But corporate earnings are holding up. We got retail sales numbers yesterday, which are strong, showing that the consumer still remains stronger than inflation. And those are all healthy signs for the economy. And as you were heading into 2023, every Wall Street pundit that you could hear on CNBC or whatever business network you were to choose would have told you that we were entering into a recession this year. 2023, we're definitely heading for a recession. That's what we've priced into the equity markets in 2022, the definite recession in 23. Well, I would tell you at River Place, we don't see the recession happening this year. We don't potentially see one happening maybe even next year either. Now the trend is, well, okay, maybe not this year, maybe the recession is next year. What we have learned is whenever a consensus on Wall Street is 100% on one side of the boat or one side of the street, whatever term you like to use, it's often a great opportunity to be a contrarian. And more often than not, it pays to be the contrarian there. And that's why you're seeing the rise in the equity markets this year is the underlying economy is still very strong that we have. And that we don't even necessarily have to have any type of lending, that the economy can still grow at a modest pace while we decide what neutral is at the federal funds rate. And historically, these are not historically high interest rates. Have they been high for what they have been the last 12 years? Absolutely they are. And we moved there very quickly. But if you look over the course of history, you can make money very well and grow at interest rates at these levels. So as always, if you have questions about what you see out there or how to navigate the next couple of months, we're not saying it's going to be a straight line up. We believe that we're going to muddle through this year, that it's going to be filled with volatility, but that we do finish a little bit higher on the year. So if you have questions about how to navigate this year or navigate your portfolio, feel free to give us a call. We'd love to talk to you. You can reach us at 904-346-3460, or as always, check us out online at www.riverplacecapital.com. Have a great rest of your week, everyone. Thanks so much.